Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is Brent Foster, Weekly Market Insights, Northbound Wealth Podcast. Inflation cools, stocks soar, month ends strong. This is a review of last month and last week heading into the beginning of June. I can't believe we're already 6 months in, but it is nice to have summer weather here. The post-Memorial holiday trading week was short but potent as stocks delivered more record gains while confidence grew that a peace deal would materialize. The S&P 500 advanced about 1.43%, while the NASDAQ Composite Index gained 2.39%. The Dow Jones Industrial Average climbed 0.9%. And the MSCI EFA Index, which tracks developed overseas stock markets, rose 0.99%. It's the ninth straight for the S&P. So the S&P 500 ended the week at 7,580.06, its highest ever close. The index also posted a record intraday high on Friday at 7,599.38. The last time the S&P had a weekly winning streak this long was in late 2023. It is now up about 11% for the year. The Friday marked the final trading day of May, a month of consistent weekly gains that followed a 10% jump in April as investors' worries about the war in Iran waned. On Friday, hopes of a peace deal increased as President Donald Trump said on Truth Social that he was meeting in the Situation Room to make a final determination on the memorandum of understanding between the U.S. and Iran. Economic data this week showed that the U.S. economy expanded at a slower rate in the first quarter than previously estimated as consumer spending growth decelerated. According to the second estimate by the Bureau of Economic Analysis, real gross domestic product increased at a 1.6% annualized rate in the March quarter. The report said down from a 2% increase reported in the initial estimate. The Fed's preferred inflation measure came in cooler than expected. The Personal Consumption Expenditure, or PCE index, rose 0.4% in April, less than the 0.5% expected. Annual PCE rose 3.8%. The gross domestic product report showed the economy grew more slowly in the first quarter than initially estimated, with the estimate revised down to 1.6% annualized growth. In a good sign for manufacturing, durable goods orders rose 7.9% in April, double the expected pace and the biggest increase in almost a year. The main reason, civilian aircraft orders soared 166% after China ordered 200 planes following a recent U.S.-China presidential summit. Homebuyers bought 6.2% fewer new homes in April over the prior month. But investors focused on the fact that homebuyers bought 8.9% and 7.4% more new homes in February and March, respectively, over the prior month. So the advance this week wasn't broad. Only 4 of the S&P 500 11 sectors rose, led heavily by a 4.6% jump in the technology sector. The consumer discretionary sector rose 1.5%. Materials added 1.2%, and industrials edged up 0.8%. Dell Technologies was the best performer in the technology sector, with its stock soaring 43% on the week. Okay, that's on the week, as the company reported record fiscal first quarter results that surpassed Wall Street estimates amid a surge in demand for artificial intelligence optimized servers. Dell also boosted its fiscal 2027 outlook. Super Microcomputers SMCI stock also boosted the tech sector, with its stock surging 30% as the company said it is collaborating with Taiwanese authorities to prevent illicit diversion of its servers into the restricted Chinese market. AppLovin, or APP, was also strong, with its stock jumping 27% as the company reported Q1 earnings per share and revenue above year earlier results and analyst mean estimates. AppLovin also forecasted second quarter revenue above the street's view. In addition, NetApp, or NTAP, shares climbed 25% as the company posted fiscal fourth quarter adjusted earnings per share and revenue above year earlier results and analyst expectations. NetApp also issued fiscal 2027 guidance above street consensus views. Best Buy, or BBY, led the week's gains in consumer discretionary with its stock leaping 26%. The electronics retailer fiscal first quarter results came in stronger than expected, and Chief Financial Officer Matt Bylunis said as its comparable sales have, quote, started strong in May with month-to-date growth up in the high single digits, end quote. It has been years since Best Buy generated a high single-digit increasing comp sales, even for a couple-week period, Truist Securities said in a note. On the downside, the energy sector fell 5.4% on the week, followed by a 3.2% drop in consumer staples, a 2.1% decline in utilities, and a 1.4% slip in real estate. Financials, healthcare, and communication services also edged lower. The energy sector drop came as crude oil futures also fell in the week amid chatter about U.S. and Iran nearing a peace deal. Hardest hit stocks included shares of ONEC, or OKE, down 11%, and Williams, WMB, down 9%. As a recap, through the end of last week, year-to-date number on the NASDAQ up about 16%, S&P about 11 is up, MSCI EFA index 8.89, and Dow Jones is up about 6.10%. The 10-year Treasury rate is at 4.45%, so we're watching that. That's about 12% higher than the 3.97% market made 3 months ago. So we're watching those Treasury yields come up. All right, charts of the week. A picture is worth 1,000 words. So if you're listening to this, you can check it out on the blog. Over the past decade, I just posted some studies that I do in stock charts on certain major indexes, and one of them is the S&P 500. I've got the RSI, the MACD, the full stochastics, the advanced declines, as well as the 50-day, 200-day moving averages, price chart, along with volume across the last decade. And what you'll notice with the S&P 500 over the last decade, it is up and to the right. NASDAQ, same thing. Basically every chart on here. So the NASDAQ composite is on here, the same types of studies. For those technical analysis nerds, you'll be able to check out pulled and what I track. Dow Jones Industrial Average is on there as well. Philadelphia Semiconductor Index, or the SOX, is on there as well. You'll see a major move higher looking at April. That's warranted. You'll see a lot of the semi stocks do really, really well. And then I actually have gold. I could keep going with so many charts. It's ridiculous. But gold spot price is on there as well. We're getting a pullback in gold. And I'm still thinking that there's upside in gold to get to around $6,300 at some point. But we'll see. We'll see where that's at. Right now, it's trading around that 44.88 level. So 4,488 for spot gold currently. All right. A key takeaway from the charts. I posted this out there. Time in the market. It's not necessarily timing the market, although it is fun when you do well at it. Be patient, sticking to a strategy, consistently investing, and not selling out at the wrong time, which is a decision you have to make. And then you have to make another decision, and that is when to get back in. And finally, knowing or understanding what you own and why you have it in your portfolio. Reviewing your strategy and goals periodically to make sure you're on track. And what's similar about all these charts? They're all up and to the right over the past decade. If you take a moment to take a look at that on the website, on the blog. Key economic indicators that are going to be announced that we're following: Monday, ISM manufacturing, construction, spending, auto sales, and some Fed heads are going to be talking. Tuesday, job openings. Wednesday, ADP report, factory orders, ISM, services survey, Fed beige book, weekly jobless claims on Thursday, productivity, and then federal employment report and consumer credit on Friday. There's a bunch of Fed heads talking all week, which I hope kind of subsides as we get a new Fed chair in there. So notable companies reporting earnings: Monday, Hewlett Packard; Tuesday, Palo Alto Networks; Wednesday, Broadcom and CrowdStrike and Medtronic; and then Thursday, Ciena. All right. Tax tip of the week: who can deduct car expenses on their tax returns? Can you deduct expenses such as gas, depreciation, and lease payments on your tax returns? Good question. If you're a business owner or self-employed individual, you may be able to. If you use your car for business and personal purposes, you may split the expenses and base the deductions on a portion of the mileage used for the business. There are two methods to calculate the car expenses you can deduct. The first method involves calculating and deducting expenses including depreciation, lease payments, gas and oil, tires, repairs and tune-ups, insurance, and registration fees. The second entails using the standard mileage rate, which is calculated to reflect gas and other factors. Taxpayers who want to use the standard mileage rate for a car they own must use this method in the first year the vehicle is available for use in their business. This information is not a substitute for individualized tax advice. Please consult with a qualified tax professional to discuss your specific tax issues. And this tip was adapted from irs.gov. Stay tuned for the next segment. True or false? Americans in March of 2026 are applying for fewer mortgages than they were during the Great Recession. True, and it's not even close. 96% of the 100 lowest number of weekly mortgage applications since 1999 have happened in the last 3 years. This is according to the Mortgage Bankers Association Mortgage Application Index. Yet, unemployment today is a fraction of what it was during the financial crisis. People aren't staying out of the market because they can't qualify. The market is gridlocked, and here's why. Number one, millions of homeowners locked in at a 3% mortgage during the pandemic. Selling means giving up that mortgage payment for one that maybe have a higher interest rate. So they're not moving. Number two, if existing owners aren't selling, inventory can become thin. Prices might stay elevated and buyers wait for something to change. And number three, most are waiting for rates to drop, but when they do, demand may pick up, competition returns, and that window closes faster than expected. Here's the truth about market timing. It almost never works out the way people picture it. The better question isn't when is the right time to buy, it's am I financially ready to move when the right opportunity comes? So again, 96 of the 100 lowest number of weekly mortgage applications since 1999 have happened in the last 3 years. Also, there's almost like a fourth reason. Let's say I'm financially ready to sell, and in many cases incur huge income tax costs since basis rollover was repealed more than 10 years ago. If I sell a house with a basis of $500,000 for $1.5 million and want to buy a new house for $1.5 million, I still have to come up with around $200,000 for my tax liability. This also contributes to the locked market. And I just want to give a shout out to David Cammons, member at HBS Alumni Angels of South Florida. He made a comment on that post that I put out on LinkedIn. And just a quick look at the mortgage market. As of June 2nd, the 30-year fixed rate's at 6.57%, and the 15-year is at 6.10%. So that's down a little bit over the past few weeks from nearly a 7% 30-year mortgage rate. So rates are still high, and it still is a problem. The housing market is going through a recession in a way that we haven't seen in quite some time. And so when rates come down and the economics get better for people, you'll see that housing market picking up, and we're starting to see that now. But it's still at very, very low levels. Stay tuned for the next segment. Hey, everybody, this is Brent Foster, and I wanted to share some information with you in regards to 529 to Roth IRA rollovers, what to know. Unused 529 funds can be rolled into beneficiaries' Roth IRA without a tax penalty. But that's probably not a reason to overfund 529 plans. This article was conducted last year by Chris Kawashima on July 10th, 2025, but I find it relevant today because it is a subject that's going on and being talked about quite a bit in personal finance podcasts and stuff. And this comes from Charles Schwab. They have a nice resource on 529 plans. 529 plans are a tool for helping families save and invest for college, but you can also use leftover 529 plan funds to help save for retirement as well. It works like this. You can roll unused 529 assets up to a lifetime limit of 35,000 into the account beneficiary's Roth IRA without incurring the usual 10% penalty for non-qualified withdrawals or generating any taxable income. This might come as a relief to anyone worried about having excess funds stuck in 529 plans should the intended beneficiary not need them. Say, if they opted not to attend college or choose a lower cost school. But could this provision prove to be something more? Could a savvy investor consider intentionally overfunding a 529 plan with the eye toward eventually building up tax free Roth savings, either for themselves or members of their family? It's a good question. Probably not, though. While rollovers may be an option for those wondering what to do with unused 529 plan assets, funding a Roth isn't the primary selling point for these college savings accounts. So, what are the limits? Before anyone starts roping off 35,000 in their 529 plan accounts, it's important to understand limitations on this type of rollover. Holding periods. The 529 plan must have been held for the designated beneficiary. Okay, that means without any beneficiary change for the last 15 years prior to a rollover. Contributions made to the 529 plan in the last 5 years before distributions start, including the associated earnings, are ineligible for a tax-free rollover. Note, changing beneficiaries may start the 15-year clock all over again, though you can still get the normal tax benefits if you use those funds for qualifying educational expenses. The IRS has yet to provide guidance on this provision, and it isn't clear who would be responsible for penalties if the rollover ran afoul of the rules. Annual limits. The rollover can't exceed the annual Roth contribution limit, which in 2025 is $7,000. It's $7,500 in 2026. So if you wanted to roll over the entire $35,000 lifetime limit amount, you would have to do so over 5 years under the current contribution limits. Ownership. The beneficiary of the 529 plan must also be the owner of the Roth IRA, and they must have earned income at least equal to the amount of the rollover. However, the normal income limits on Roth IRAs don't apply for rollovers. Even beneficiaries with high incomes can take advantage. What you can do. Here's some things to discuss with a planning professional before queuing up a rollover. If you're planning to open a 529 plan for your children, consider funding different accounts for each child. As noted, changing beneficiaries may reset the 15-year wait period on potential rollovers. So if there's a chance you might end up with leftover funds in the future, having multiple accounts could simplify rollovers. Considering opening a Roth IRA for the beneficiary, so a custodial Roth, that is. Regardless of whether the beneficiary's 529 plan ends up with unused funds in the future, you could still take this opportunity to contribute to a child's Roth IRA so long as they have earned income. This would help them get started on their retirement savings at a time when their personal income tax rate is likely to be low. And it's more efficient to contribute directly instead of taking a detour into a 529 plan. If you're concerned about the assets in an overfunded 529 plan, you already have other options. As noted in this article, parents can still switch designated beneficiaries at any time and continue using 529 plan for qualifying educational purposes, plus up to $10,000 of 529 plan funds can be used to pay off qualifying student loans. Finally, if the child earns a tax-free scholarship, parents can take an equivalent amount out of the 529 plan without the 10% penalty, though the earnings portion of the distributions will be taxable. Overall, this provision gives savers another way to put 529 plan assets to work, but it's probably best to treat a 529 to Roth rollover as a potential backup option rather than a retirement savings strategy unto itself. So, stay tuned for the next segment. We've got more for you. Will the corporate investment in AI pay off? That's a big question going on right now. May 11, 2026 article by Goldman Sachs Research. And I wanted to go over that as I found it informative on what they're saying. While consumer adoption of AI has been spectacular, most of those users are accessing a free version per Goldman Sachs research. Successful enterprise adoption will be critical for AI economies to work. For enterprises to unlock value from their AI spending, data needs to be properly structured for agentic AI, and workflows need to be orchestrated efficiently to control costs. Even as semiconductor makers see record revenue and profits, most companies elsewhere in the AI ecosystem have yet to make money from the technology, a dynamic that is not sustainable. Semiconductor companies have outperformed the broader stock market. From here, though, Goldman Sachs research expects hyperscalers to outperform semiconductor companies. So, for artificial intelligence to live up to its promise and for returns to spread beyond the semiconductor companies that have enjoyed most of the benefits so far, enterprises have to unlock greater value from the technology, according to Goldman Sachs research. Ultimately, successful enterprise AI adoption will drive the economies for the entire supply chain. And they said, quote, the general idea is that chip companies are supposed to thrive when their customers thrive, writes James Covello, head of global equity research at Goldman. They are not supposed to be thriving at the expense of the companies higher in the chain. Is AI living up to expectations? Consumer adoption of AI chatbots has been spectacular, Covello writes. Generative AI reached approximately 53% adoption within 3 years, measured from the release of the technology's first widely available product. According to the Stanford Institute of Human-Centered AI, that's well above the initial trajectories of the personal computer and the internet over a comparable time frame. The speed of adoption by technology, you've got the internet, ITU, computer, and then internet source, CPS, and then they have AI, and they have it all plotted on like kind of a dot plot type of chart. And AI is at a much steeper trajectory of adoption, so quicker adoption than any of the others. Most enterprises are yet to generate any returns from their AI spending, Covello notes, citing a study from the Massachusetts Institute of Technology, or MIT, and other reports. As a result, other parts of the AI supply chain are struggling as well. The companies making the models and the hyperscalers building the AI infrastructure are burning through cash and boosting their borrowing. While semiconductor companies are seeing record revenue and profits, the overall dynamic is unprecedented and unsustainable, Covello writes. Where are the investment opportunities in AI? It's a great question. The team points out that about 2 years ago, they recommend that investors take a picks and shovels approach to the AI boom, investing in semiconductor and semiconductor equipment companies, or semi-cap. Since then, these stocks have outperformed the market while the hyperscalers mostly have not. From here, though, Goldman Sachs research expects hyperscalers to outperform semiconductor companies and those that make equipment for semiconductor companies. For one thing, investors have become fairly skeptical of the returns of the hyperscalers are likely to deliver. If enterprises begin to show returns from AI spending, investors may be willing to pay higher multiples on these stocks again. Even if returns on enterprise AI spending continue to be challenging, the hyperscalers may decide to trim their capital expenditures. This may be the best scenario for this trade, the team writes, causing a relief rally in the hyperscalers on better cash flow prospects and a sell-off for semiconductors. The worst scenario for this trade would be the status quo persisting and hyperscalers continuing their huge capital outlays despite challenges for successful enterprise AI adoption. Investors would lose money on the trade in this scenario, as all the value of AI spending would continue to accrue to the semiconductor companies. So, how can enterprises better use AI? The big question, according to Goldman Sachs research, is how companies can create economic value from their spending on AI. The researchers suggest they need to ensure that they are building their agentic AI on the data that is structured properly, and they need to deploy or orchestrate AI models in a cost-effective manner. Let's see, he says, quote, models will continue to improve at a fast pace, but right now, model capability is not what's holding back successful enterprise use cases, Covello writes. We believe a data structure and orchestration are critical factors to unlock AI in the enterprise space. A new layer needs to be added between the enterprise and the model developers, he adds. One goal for this orchestration and deployment layer would be to ensure that workflows are routed properly based on complexity and cost considerations. Low consequence, higher volume workflows should be routed to simpler AI technology, open source, or lightweight models. Higher consequence tasks can go to the most advanced and expensive models, which will be reserved for environments where the cost of failure is high. How should executives approach AI in their businesses? The researchers provide an example of how this might play out at a hedge fund that wants to put AI tools in the hands of its employees. When someone queries the AI with what is essentially a glorified web search, that would be routed to a lower end model. On the other hand, when building a new financial model or conducting complex valuation analysis across industries, the work might be routed to a more expensive, higher powered model. One approach that holds promise is to deploy small language models in contrast to the foundation large language models that attracts attention. SLMs can be optimized for speed and lower cost, and they can be tailored to a specific workflow. Small models can be faster and increase accuracy even as they are much less expensive to train and use, showing the cost effectiveness needed for successful enterprise AI deployment. The new layer between the enterprise and the model providers would also address data issues. A basic example might be to ensure that a retailer's data is aligned and accessible so that an AI tool can give helpful customer suggestions. That will only be possible if the databases for recommendation algorithms, consumer behavior profiles, and current inventory are all properly organized and not soiled. We believe organizations getting these building blocks in place will be key to unlocking AI economies in the enterprise space, Covello writes. The researchers suggest that C-suite leaders might want to play the long game, given that some of what's needed for enterprise AI success is not yet in place. Slow down now so you can speed up later, Covello writes. This won't be easy, he admits, given the immense pressure executives face to show that they have a strong AI story and the fear of missing out that seems to be driving shareholders and markets. Which jobs and industries are likely to be disrupted by AI? One place where markets have been watching for the impact of AI at the enterprise level is in the large-scale job replacement, and this has not yet occurred. Goldman Sachs research shows that while AI is replacing some workers, these job losses are being partially offset by rising employment where AI augments human workers and boosts their productivity. We think the markets need to look beyond jobs to feel comfortable that there will be eventually a return on investment. That means exploring for profit pools that could be ripe for disruption by AI in the years ahead, he explains. Goldman Sachs research equity analysts have identified a number of industries where large-scale profit disruption seems more likely, including advertising, software, cybersecurity, and transportation. In the advertising businesses, for example, the creative process could be disrupted, and there's potential for automated process for ad generation. In transportation, as robotaxis and autonomous heavy-duty trucks gain acceptance, the disruption to existing U.S. markets could potentially be around what they estimate as $440 billion, the researchers find. So this is a story that will continue, a narrative that's going on, driving markets, the AI and the AI adoption at the enterprise level. Stay tuned for the next segment. U.S. data center power demand projected to double by 2027. A May 20th, 2026 article by Goldman Sachs Research says a new wave of data center construction fueled by surging demand for artificial intelligence computing is on track to more than double the power used by U.S. data centers within 2 years, according to Goldman Sachs Research. What is the forecast for data center power demand? U.S. data center power demand is expected to climb from 31 gigawatts in 2025 to 41 gigawatts in 2026 and 66 gigawatts the year after. So by 2027, Hongchen Wei and Dan Struven and Samantha Dart from the commodities team at the Goldman Sachs Research Center. This demand forecast is based on the estimate that U.S. data center capacity will increase to roughly 95 gigawatts by the end of 2027, more than doubling the level at the end of 2025, and a capacity utilization rate assumption of 70%. The acceleration is substantial. Year-over-year capacity additions are scheduled to reach 13.6 gigawatts in 2026 and 36.6 5.3 gigawatts in 2027, compared with realized additions of 6.4 gigawatts in 2024 and 8.5 gigawatts in 2025. The forecasts draw on data center development schedules from Ontario. The Ontario data on data center activation uses granular facility level data covering locations, permitting progress, construction status from official announcements, and satellite imagery. How much is the data center industry projected to grow? Not all those ambitious construction schedules will translate into working facilities. Historically, only about 72% of data centers scheduled for activation within the following 4 quarters actually went online on time. The further out a project is scheduled for activation, the less likely it is to be completed as planned, according to Goldman Sachs research. Several factors explain the gap between plans and reality. Data center developers frequently submit applications across multiple regions simultaneously, proceeding only with the most favorable site. Supply chain and labor shortages remain the most common causes of delay, and the typical data center takes 18 to 24 months to build once permits are secured. After adjusting for these risks, they forecast approximately 60% of capacity scheduled for the next year will materialize on time, dropping to roughly 50% in the next 2 years. Even with those conservative adjustments, the projected additions remain significant. 11.5 gigawatts in the final 3 quarters of 2026 alone, following a 2.2 gigawatt realized in the first quarter. Which U.S. markets have the biggest increases in power demand? There is a sharp regional difference, in Goldman Sachs research outlook for power demand. In 2027, the average annual data center additions in each of the mid-Atlantic, Texas, and mid-continent power markets are individually scheduled to exceed the entire nation's total additions in 2025. But the consequences vary. Power reliability risks are elevated in the mid-Atlantic, mid-continent, and Northwest markets because their planned generation capacity additions are limited relative to the flood of incoming data center demand the team's analysis shows. These regions may ultimately have to turn some future data centers away. Texas and Georgia, by contrast, are expected to see only marginal tightening. Both regions have significant new power generation capacity in the pipeline, which should help absorb the additional load. Meanwhile, markets like Tennessee, New England, and Florida are likely to see constrained data center additions since the market is already critically tight. So, where are they being built? Power availability and time decline are primary factors driving where data centers choose to locate, Goldman Sachs research notes. The share of U.S. data centers in total peak summer power demand is projected to rise from 4.1% in 2025 to 5.3% in 2026, 8.5% the following year. That incremental tightening will have consequences for electricity prices and grid stability across the country. This team cautions that the outlook carries meaningful uncertainty in both directions. On the downside, delays and cancellations could reduce the amount of activated capacity below current projections. On the upside, new projects not yet in the pipeline could push actual additions even higher than scheduled, particularly in later years. Elevated capital spending could also compress construction timelines to as little as 1 year, accelerating the build-out beyond historical patterns. So what I'm looking at is a lot of it's happening in the Midwest, Texas, some in Arizona, Nevada, but mostly Virginia, Ohio, Indiana, Iowa, and the Texas South region. So it's kind of happening all over the place and all over the country. We'll stay on top of this through looking at different research articles across all the major banks who do a lot of financing for big tech and the rest of them. So it's going to be a story and a tailwind for the markets, but also there's risks. So we got to understand those as we go. So hopefully you found this educational, and I hope you guys have a great week and weekend, and we'll talk to you soon next week on the Northbound Wealth Podcast. Thanks for tuning in. Like and subscribe.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. and make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.